Okay, here we are. Yeah, still trying to use this software correctly, so I apologize for this. Welcome back. This is our promotional stream. We're promoting WTC1, the Wyckoff trading course, which I will be teaching this fall, 2025. Uh, Go to our website, check it out. I'm basically going to combine two concepts as I see them differently right now, chart reading and Wyckoff method. And even for those of you who have taken this course before, the alumni, this is a major revamp. So with that, I would suggest, to come and to get it at the alumni rate. With that, let's go into questions. I was wondering what you guys are going to come up this week. Okay, so, and actually, Owen wanted me to ask this question first. Is Wyckoff method a more subjective methodology, or can it be approached systematically with well-defined rules? Yeah, I mean, I would probably at this stage of my career where I've spent more than 30 years studying Wyckoff method, studying charts, I would say that Wyckoff method is definitely it's um, it's definitely a concept. I'm gonna say this concept plus system. Okay, so how is it the concept? It basically answers the main question um, of why. Why the price moves this way, why there is a change, why the structure is this variation, why we have a sell-off or a melt-up. You know, there is an explanation of why to every possible, well, not every possible, but the majority of the price action, volume action, time duration, character, that's all being explained in the methodology. Now, system is going to be user defined. So what do I mean by that? Because the method is so vast, it covers practically everything in terms of, how you should be thinking about supply and demand, right? And especially when you multiply it with, with the concepts from chart reading. I mean, like it just becomes very clear. Again, I see that in training a lot, especially because it's like the more advanced immersion into the trading that we have as a product. Um, I definitely see how the chart opens up to people or trainees. Like they suddenly, boom, they see everything. And you're like, okay, you kind of like jump the threshold right there. Okay, so with that, that's probably my, after 30 plus years, my modern view on Wyckoff methodology. You're going to have a lot of user-defined systems. So somebody might be using the methodology, and I have a lot of questions. What about the low-priced illiquid stocks? Can you use them there? What about Forex and the volume signature? Could you use that on cryptos? Could you use those on options, futures, and so on and so forth, ETFs? And everywhere where you have the relationship between the price and the volume, you could use it. Yeah, absolutely. Okay, great. Let's continue. Okay, so I see a question from Daniel. Daniel, are you asking about the current market? Is that why you're asking this question? Daniel is asking the question of how can we distinguish whether we are currently in the backup or LPSY, last point of supply, or actually in phase B of a larger time frame, which is likely to move lower. I'm assuming current chart. Okay, let me see. I see the comments are sliding down. Okay. Daniel, are we talking about the current chart? Oh, you were in Ethereum long. It was looking like the last point of supply and phase in 5 minutes. Okay, well, we're not going to go to the charts. We definitely, I want to concentrate on kind of like, more Wyckoff method, chart reading type of questions. I want you to see the benefit of the work that we do in the company. So for all of the market type of questions, I mean, today we have a class at 3 p.m. where together with Bruce, we're going to go through all of the charts of the market. So like you are absolutely welcome to join us. But conceptually, a backup or last point of supply, um, that's an interesting question. So one of the things about the backup, the back in action. So let's say like we're talking about like this action right here. It's backing up some kind of structure, right? So it's backing up the stop in action, it's backing up the change of behavior, it's backing up uh, secondary test, and then we come to the resistance pretty aggressively. Demand is increasing here. We have a gap, and then the exhaustion bar, this one right here, is pretty strong. It's almost like it becomes in itself an impulse bar. Still cannot overcome, the resistance right away, which is some sign of weakness. But because of the background strength of this big bar, all of the buying that we have here, very favorable tests in terms of the space and in terms of the character of how the price goes down, the ability of the supply to contract by about 60%, so rapidly, disproportionately. That all shows background contextual strength. So with that, we know that this inability to overcome immediately, that's probably still going to be shown in the test as a strength. So with that, we're anticipating a much flatter correction than the last one. And with that, that's the biggest correction right here on this bar. And look how much demand is coming in right here. On the test itself, nothing is happening in terms of the volume, so that tells us that supply is more dormant. It's not very aggressive, and all of the bars that are supposed to be, down if you can't overcome, the resistance immediately, they're all up. All of the closes up. There is a gap here, so quite a lot of strength. So this type of backup, obviously, more of kind of like a local backup. You could just VSA that. You could also, make assessment, give some weight to the background, immediate background. That would be my suggestion. There are some other ways of how you could look at this. Not going to go into more advanced stuff, but that's about it. Then, in terms of the last point of supply, so let's say like we're looking into, let's say this area right here. So here is your last point. Oof. Of supply. Okay. Um, so you had an upthrust. You had a lot of selling here, right? So pretty aggressive with the gap. So there are some ruptures there of the tape. And that's all on news. So current market is just like so news driven, just because of the administration. Just the news cycle is much more aggressive and much more kind of like, I want to say almost like a more significant news, more rapid. So we see that the market has changed. Like there is a lot of ruptures on the tape. News-driven market. And then prior background, obviously, this bar is the most important bar after the election bar. So it kind of defines what is happening. Sign of weakness, even though it's been hidden as a spring. Best rally does not produce any result. Aggression, deterioration of the demand to the larger degree compared to the previous rally. Then we have, very decisive change of character on the increase in supply, and we come to the last point of supply. You could also say that this point too, you could see as one of the resistance points that is being reached. So, how would we think here that this is the last point of supply? Again, the background is extremely important, and we could go into the background of the approaching rally, which is where we should start. But, like I'm just going to show you the structure here, the trading range. So in the trading range, as I said, there is a lot of signs of the of weakness, emergence of supply, and control of the supply that depletes the demand. So that's what we want to see from the analysis of a trading range like this into the last point of supply. And then into the last point supply would be nice to see already a change of behavior, right? So, and we see that. And it's definitely the lag that is improving everything in the trading range. Same here at point number 2. We see that the largest selling has emerged both in volume and in the decline itself, in the reaction itself. It's the largest reaction. It has the largest cumulative volume. The demand inside it, 1, 2, 3, 4, 5, all of that is pretty mediocre compared to the down bars, compared to the extension that this reaction has. And then we know that after the local exhaustion that happens in this area right here, we're going to have some kind of rally. The rally starts not that decisively, so a suggestion that we're going to have most definitely a lower high, number one. Secondly, the rally that's going to be somewhat deteriorating. It might be better than this one. Again, like I'm just looking at my um, visuals there. Again, some of the stuff I'm not going to go into. It suggests a better rally than what we had here, but still into the lower high. So usually I'd like to define some kind of target zone, not necessarily just one line. So this makes sense to me right here that the price comes here. As it comes here, we see one of the lowest demands, decreasing demand. The spread is not as high as the spread to the downside. So you could see the continuation of the story of the distribution at that point. So then you would be thinking that this is the last point of supply, and therefore the positions that could be opened are somewhere in this area for this trade right here. Okay, I don't know, Daniel, was that it? I mean, like, is that what you wanted to go through? Hopefully. Let me see, I'm just coming back. Okay, while Daniel is thinking about this, let's go to, okay, Has, okay, Nordisk chat. Okay. Again, let's just discuss this in, okay, hold on a second. Yeah, sparked my interest a little bit. Let's look. Has, is that the symbol NOVO? Because I can't get it on stock charts. Okay, while you're thinking there, let's go somewhere else. Volume trader is asking, what is weakness of Wyckoff trading? Is that the question? Like, what? How does Wyckoff methodology looks at the weakness? Is that what it is? Volume trader. Okay, great. So let's just say, can I rephrase the question like this? Is that the question? Is that what you're asking? Okay, well, let's talk about this. What is weakness? Well, I think there is no necessarily like what is Wyckoff weakness, right? So that's kind of probably would be too much for the methodology, to claim. Um, okay. So what is weakness just in general? Deterioration of dominant force. So it could happen in different ways. We could see a more climactic deterioration. We could see deterioration through the decrease of the presence of the either buyers or sellers, which uh, uh, leads to a change of behavior and to the change of environment. So we could go in an uptrend, then the dominant force could deteriorate. Very good example, like more local example right here. Look at the strength here, right? Compare it to the strength of this. So still pretty strong, right? Because the distance of the rally is pretty significant, almost like maybe like 1 and 75 to the first rally that we had, right? So we're increasing the distance. So that's an element of strength. Plus, we're doing it on this volume, which is not very high, consistent. So there is some kind of ease of movement that we're seeing. We are going through specific, you know, points of interest to us in the structure levels. And as we do so, as we observe the character, yeah, we're still seeing a lot of strength, like in this breakout bar gap and ability of the price to overcome the resistance in that way, and then have the follow through to the upside with 5 bars like that, with all closes up. So it's still much stronger, right? Then this is a structure on its own. So I would omit that from the impulses, comparisons. And then I would go into this. So here I'm seeing that, yeah, we are not going the same way as we started, let's say here. So with that, I see that demand, even though is dominant over supply, but demand is actually starts to deteriorate. So um, I know that there's going to be more to the upside, but I know that if the next leg up out of some structure is going to show that further deterioration, and I could see this from the volume signature, I could see this from the comparison of a swing to a swing, then I know that I'm entering the area where the weakness of the dominant force exists. And if that's the case, the emergent supply could easily produce a more meaningful reaction than the reactions that we had prior, let's say like in the most recent swing. So with that, there was always this anticipation of this reaction. And I would say like overall, just like looking at the social media, you know, fintech, all of the people that comment, obviously I read, some of them. There was that anticipation, for the reaction. So I'm glad that a lot of people in the industry caught this. But yeah, it just shows now some change. This spread, down spread, and the increase in the volume signature comparison to the previous reactions suggests that this is more meaningful than, let's say, like this reaction right here, right? Even this reaction is not that strong. If we were to compare to the entry into the different environment, like in this structure right here, this is definitely more aggressive. In a shorter period of time, like in 2 bars, if you consider this the high, we are aggressively going down. Here it took us 4 bars to travel almost the same distance. Look at the increase of volume over this right here. So it's different. It feels different. Now, having said this, it doesn't mean that we, after the period of some kind of testing, consolidation, and again, like you go to all of the analogs, you still could potentially go lower. I mean, like the price should be able to, let's say, come to this level because of the level of the resistance that we had here. And we still would be okay in terms of the uptrend. And even if it goes lower, I mean, there are instances when we kind of come back into the beginning of this bar right here, and that still would be okay. And because the stride has changed, yeah, we are doing something like this now. So there could be some kind of like more meaningful low here, still in the context of the uptrend, possible uptrend. Remember that, when you think about what kind of trend you might potentially have here in terms of the structure of the trend, whatever I have here, in terms of the lines, that just like much more previous understanding of like how the trend looks, right? So one of the things that I was saying, stating in the last maybe, I don't know, couple of months is that we're residing more in the lower part of the uptrending channel. So that's a structural weakness as we talk about the weakness. So it shows the vulnerability for some kind of reaction. Could be short-term reaction, could be more meaningful reaction. So with that, and with the understanding that this initial move was pretty strong. This structure here, where phase C is at the meaningful higher low, so still strength, where we overcoming the all-time high and we just barely stopping here, and we extending progressive closest to the upside, so still strength, consolidating pretty high above the support and still continuing to go up. Yes, this is in itself an exhaustion, but it could be an exhaustion of the local last move. And here, when we go into 2020, 2019 type of analog scenarios, and we see that we could have a meaningful change of behavior, we could have even have like a trading range right there, of full-blown proportion, and still we recover to the upside. So that's probably the most that I'm going to give you guys on the market today. But yeah, see how a simple question of what is Wyckoff weakness produces a discussion like this. Yeah, so thank you. Okay, let's go to Mehdi. I hope I pronounced the name correctly. How can I effectively differentiate between genuine accumulation and manipulation in volume patterns, especially in volatile and thinly traded markets? So we're talking about low liquidity type of stocks. Yeah, lately, just almost my like favorite subject to talk about, because I don't know, for some reason there are quite a lot of questions about the low liquidity stocks and how like you could use Wyckoff methodology and also chart reading. So low liquidity. Okay. So one of the things, I'm just gonna give you the steps. I'm just not gonna like talk about this conceptually. Um, so before um, volatility and liquidity increase, um, okay. Ooh, don't use don't use Wyckoff. So it doesn't make sense there. Like the price could be just like, resting without just any participation from the institutions or speculators. And this is probably just one area where I would say there is a lot of speculation that's going on. I've been just diving into the process of dilution, and it's just brilliant how in the modern era they are practically doing the stock operators, type of stuff that was like mm, widely done, like more than 100 years ago. But it's still, as I see it, it's still law compliant. But the principles of the way how they mark up the price and then they sell into that strength and then the price goes down, if we're talking about the same thing, Mehdi, then yeah, it's kind of an interesting way to observe, the same principles that people used as stock operators, 100 plus years ago. Okay, so don't do anything, until volatility and liquidity increases, right? But once liquidity increases, go long. That's what I want you to do, because usually you have the first push up and then you have the push down. If you're just like looking for the stocks that unsustainable in the uptrend like that, so they might be marked up for a day, 2, 3, 4, 5, maybe a week, something like this, and then they go down, retracing almost all of the gains. Okay, so when liquidity comes, it means that participation by the speculators increases. So you need to find some kind of loan point of entry because they're gonna, drive up the prices. Then you need to find that, you know, um, find deterioration of dominant force. So pretty interesting and challenging task in this low liquidity stocks to do exactly that. Why? Because let's say like for a stock that is, let's say like 50 million in cap. So this is just like a tiny, tiny stock in comparison to, let's say, like all of the other stocks that we have. How do you think the price is going to move? Very aggressively, right? So, and this aggression can continue for some time. So you need to be able technically to identify the change of character in such stock. So deterioration of the dominant force. Uh, then emergence of opposing force. This is pretty easy. You're going to be looking at the volume characteristics. You're going to be looking at the result of the opposing force in the dominant force bars or swings, and then that should give you a good indication of the emergence of the opposing force and its influence, right? Okay, and then once you see that and the opposing force result improves, go short. That's about it for this strategy. If you are talking about the low liquidity stocks that, let's say, continue their uptrend and become high participation institutional stocks in the uptrend as they start accumulating on the way up, that's a different type of conversation. I'm assuming here that the question was about the low liquidity trading. Okay, yeah, for some reason, quite a lot of questions lately about that. Okay, Haas is asking, I mean, do you usually combine Wyckoff with other tools like PNF, point and figures? Yeah, absolutely. I mean, like this is just a routine for us to use the PNF. I would absolutely point you to the work of Bruce Fraser, who has some free videos on our YouTube channel, Wyckoff Trading Method. So check it out. Also check out his blogs on stock charts. Bruce has written like a book full of blogs, so I would just read it like that. And then, yeah, I mean, again, WMD class today. So come at 3 p.m. Pacific. And Bruce and I will be discussing all of the markets. And with that, like he will be bringing a lot of PNF charts. Okay, next one. Can we automate Wyckoff methodology into scripts and agents to automate and systematize and take out human emotion? For instance, in the WMD sessions, John D. Okay, yeah, hey, John. In the WMD sessions last year, you had some stock screens, maybe new offer. Yes. So this is the question. Automation of Wyckoff. Is it possible? Yes, it's possible, but it's not possible fully. At least at this point of like AI development, where it's still pretty simple. Like we need to use generative AI that could uh, understand the context of the background. So this is just more data points. This is just more rules, and we're still kind of like very primitive, I think, in codification of the Wyckoff. I've seen quite a few attempts to codify Wyckoff method, or let's say chart reading in general. Some are more successful, some are less successful. There are usually kind of like pockets of success that I would define in scripting and codifying Wyckoff. If you take just one concept, maybe like a concept of oh, one bar has an abnormal volume signature, the next bar that follows has still abnormal signature, volume signature, but the spread in the body contracts. You could add that the next bar or on the next bar that contracts in the volume signature, that would define the test. Here's your script right there, right? So I'm describing this stop in action, this selling climax right here was the test, local test. So, and I'm saying that when you see this pattern, the price should behave this way, right? So, and then you could go and you can backtest that in some kind of sequence. Here's the scenario again. Bar on somewhat elevated volume signature, next bar diminishing in the spread and in the body, and then the next down bar, the next dominant bar, is decrease in that supply. You could also, account for the result of that particular bar. So this is much better on the exhaustion of selling than this one right here, because this one is showing still, close, which is the lowest out of all of the four bars. So therefore, the reaction is going to be different than this one. So those type of things that are, local events, you could absolutely describe. I thought that what I saw, like as a big success is probably just like VSA automation. I see that there is some work. I've seen some work that has been done on the Wyckoff labeling. Now that was interesting, a little bit controversial because in a lot of cases it couldn't finish labeling. So it would start with the stop in action, change of behavior, which is basically the automatic response, and secondary test. That was pretty easy to identify. And one of the things that I always tell my students is, like you look at the trading range, start in phase A. Start at this where the story starts. Like what is my last climactic run? Where does the price stops at which level? How much of the dominant force to the opposing force, and what kind of result do we have, what kind of change of behavior we have, and what kind of character of that do we have, and then secondary test. And a lot of the picture to you will about the potential bias will come right away, and you could follow what happens next. Is there some kind of deterioration into phase B, especially the second part of phase B? Then you should take all of that into the account, for your bias analysis. Okay, and then the last thing that I've seen is there is a lot of like character automation. So this is statistical type of data that is given to us either visually or as an indicator or numerically. And then it just tells us about the strength of the dominant and the opposing force on any of the swings, on any of the bars, and so on and so forth. I think that all of them are pretty interesting, and could be extremely useful in either our trading as we're trying to interpret what's going on. My preference is still to do the dirty work myself, right? So to look at the chart, to know the patterns, to do this with my mind. But I'm definitely have been developing, some of the tools, and maybe like this is, what John is saying, like bring it to the community. Yeah, we could probably do some of this. Check out Alessio's work. Like he's been automating some of the stuff, like the PNF. And we have a lot of automation tools on selection for stocks, right? So where you could do your top bottom approach relatively easy and quickly. So again, go to our website, check out the our some free tools that we have on the website. So okay, great. Let's go somewhere else. Wilson is asking, any class coming out scanning for Wyckoff patterns? No, we do not plan on those classes. Everything is kind of becoming simpler with AI. I mean, like you literally can create the scans now. Just go to AI and say, like, for the Pine script in TradingView, I want to create the filter that's going to behave this way. Boom, boom, boom. It gives you the code. You put it in. A lot of the times you're going to have a lot of mistakes, so you just have to come back to AI and ask for the change in the code based on the mistake, and so on and so forth. You will come to some final version of it, and I find it useful, creating those type of indicators using AI without asking the help of anyone else. So just do that. Okay. I think the name is John Pablo. Okay. Hello, Professor Ramon. I sometimes get confused about interpreting volume. Can you mention the most essential characteristics that volume should have in the accumulation and distribution ranges? Okay, so this could be quite a big subject for someone like myself who is constantly day to day immersed into the thinking about like chart reading and Wyckoff methodology. I mean, like, uh, some of the questions when you ask guys, like you're probably looking for a very straightforward, simple answer. And when I see the question, I have like gazillion of thoughts in my head already, like going in different directions because there are so many nuances to a question like this. I get confused about interpreting the volume. What are the most essential characteristics? So my preference as a teacher and as a coach go to simplicity, but I want to explain some complexity behind that as well. So let's do this, interpreting the volume. Okay, so the most basic things that I would want you to observe is the volume bar, right? So with that, volume bar increases or decreases. That's the most simple observation that you could make, right? Okay. Secondly, uh, volume bar increases or decreases relative to previous bar, right? So now, what are we doing here? Comparison, right? So we're comparing, uh, let's say, current bar with the previous bar. You could also start looking at the context of volume emergence. And I'm trying to kind of, make it more complex for your step-by-step or understanding of what needs to be done. So context is going to be the next thing. If you're looking at the previous bar, then you could ask a question, okay, well, these two bars, so the current bar under observation is a part of what? It could be a part of a swing. It could be a part of structure. There could be also, as the next step, look at the analogs, analog bars, and compare. And you could do both on both sides, dominant force and the opposing force analog bars. So those are going to be different. Okay. Okay. Um, you could also think about the volume as volume per price measurement. So this is probably one of my favorite things. I do this visually. I don't necessarily want to calculate this for each bar, for each swing. It's more about the understanding of the character of the dominant or the opposing force. What's the ease of movement? I call it more of the ease of movement. What's the ease of movement on the current bar? Is it increasing or decreasing? And then the most important thing in the volume and the most important observation that we could make is how does the price reacts to current volume? And that would be it. I just want to accentuate this question. How does the price react to current volume? So that's how I would be observing and interpreting the volume signature. Hopefully that was helpful. Okay, let's see where we are at 7:43. Let me see. Okay. Okay, I see. Here's the stock NVO, right? So I think that we're talking about this climactic action, right? I already lost the question itself. The proper bottom in such a sharp decline. Is it possible to fish the bottom using in this case? Okay. Um, yeah, so you have to think here, like if something comes, like how would that look like? Like continuation, right? Let's say like you're thinking that this is the stop in action, like we had one in December, right here. So what comes next? Usually just a different environment, so a trading range. So what is your trade then? Most likely, in more cases than no, if we're not talking about the V type of recovery, you're going to have a trading range. So your trade here, possible trade on the local exhaustion of selling after the climactic type of move, is going to be that change of behavior bounce up. There is nothing else in that trade. So you could most definitely do that, unless you believe that this is going to be a V recovery. So in V recovery, it happens in a different way. So with that, in different ways. So with that, you just kind of like have to make that choice. You could probably tactically be choiceless at this point. You could say like, I'm going to trade this rally, which is going to be a change of behavior. And then as it unfolds, looking at the character and the result, I could make that decision whether it's going to be a V shape or it's going to be like a trading range. And your tactical decision on the trim could be reflective of that. So that's probably as much as I could say about that. Okay, well, I think that's it for today. Wow, quite a few questions covered. Guys, thank you so much for being here. Again, we're promoting WTC1, Wyckoff Trading Course Part 1. We're going to have the free session, so sign up for that. We're also going to have that open doors uh, session where I'm going to be going through the material, but I'm also going to be introducing, like everything of what we're going to cover in that class. So that is a very, popular session to attend. So would expect a lot of you to come. So go to our website, sign up, and I'll see you there. And until then, I think we're still doing this live stream for another maybe 2 sessions or so, maybe 3. So with that, I hope to see you next week at the same time. Thank you guys, and bye bye.